Hi, I'm George Mitten, investment writer here at Nutmeg. Today I've got Pacome and Brad who've agreed to sit down and give us an update on the markets. Some people are predicting that the Bank of England will cut interest rates at the end of the month. Why would they do this?
Well, a speech by Mark Carney, Bank of England governor, has alerted the market to the fact that there are some within the committee who'd like to lend further support to the economy. They're worried about business confidence, and so they're looking at the confidence data quite closely at the moment to see whether post the election further support is needed. Now, it's important to mention that apart from the negative rates in Japan and Europe, UK already has quite low rates compared to most major economies. And so policy is quite pro-growth. And in the context of the post-election confidence bounce, in the context of greater fiscal spending, it might be, the bank might decide that it's better to hold their powder dry until later in the year.
The US and China have now signed a Phase 1 deal. Does that mean the trade war is over?
Well, the first phase of the deal was signed mid-January between the US and China, and it was a positive outcome for the market and for both countries. The market reacted positively, and actually the US market posted new high on the day to highlight this point. However, it's only a Phase 1 deal, which means that China agreed to increase US import by 50% in 2020 and by a substantial amount as well in 2021. And on the other side, the US will remove some of the barrier in 120 billion of Chinese goods. So the positive side is that it will bring some stability and a more stable outlook for 2020, or at least up to the November election in the US. The negative side is that it's only a Phase 1 deal, and what it means is that a Phase 2 will come likely after the November election in 2021, and some of the difficult topics will be back on the table, which means technology or intellectual property. So overall, to answer your question, yes, it's good because it brings some stability to the outlook for this year and up to the end of the year. But some of the difficulty will come back next year, and it's not even sure China will be able to implement what they promised in this Phase 1 deal. So at the moment it's good, but let's see the development next year.
We've seen some fantastic returns in the first few weeks of the year. Will these continue, or are there headwinds?
Well, over the last 30 years, we looked at the numbers, and we've seen 4 years where the market performed better than what it did this year. Interestingly, in 3 of them, and I think it was 96, 2013 and 2019, the market ended up with returns in excess of 20% for the year. However, there was one occurrence, which was 2018, where the market started in an even stronger shape and ended up as a negative year, which was disappointing. So I think we should not put too much emphasis on this number. It's been a good start of the year. It's been good for our investors, good for our portfolios, and we're happy to see it. However, by itself, we don't think it should be seen as having such a predictive power for what the rest of the year will be.
And I would just add that in terms of headwinds, I mean, there are always headwinds in markets. That's the nature of markets. There are always risks. But our view is that the global economy is improving, that it's catching up with the US. It's already very strong. And that'll be good for growth. It'll be good for profits, and therefore good for risky assets. So in that context, any minor pullback after such a strong start to the year would not be of concern to us.